Good day, you traders. Welcome to another installment of our UTrade webinar. So for today, the title is Fourth Quarter Game Plan, Major Comeback or Another Setback. So I, Justin Trembrevilla, the research head of Unicapital Securities, will give to you an update on how the macroeconomic is going on. So as you can see on the outline, we'll give a brief review on the macroeconomy, a touch on Wall Street, and the meat of our discussion will revolve around the local markets, wherein we will discuss the PSEi performance, member performance, some valuation, and our stock picks, as well as index forecast and strategy. So let's start. So for a quick macro review, you can see two charts. First is the GDP and the Philippine inflation. For GDP, recovery could gain steam from narrowing trade deficit as we enter fourth quarter. Of course, the recovery will be fueled by improved trade, even though imports have been on a steep decline since the lockdown has been implemented. Also, one thing to look is the improving remittances from overseas Filipinos. So later we'll see a chart depicting a strong rebound for remittances for the month of July. Also, recovery could come from the fiscal stimulus from the Bayanihan 2 or the stimulus package amounting to 165 billion pesos, which was signed by President Duterte just a few weeks ago. Also, one thing to look into is the approval of the 4.1 trillion 2021 national budget, wherein the government could spend this money next year on its key projects, which could spur growth as we go post COVID-19. So if you look at the GDP in the second quarter, it dropped to a record low of 16.5% or negative 16.5%. And national government is looking at contraction of negative 5.5% for full year 2020. So this forecast is quite optimistic compared to other forecasts such as the 8% contraction from Fitch, negative 7% growth from Moody's, but slightly better than, or S&P gave a better reading of negative 3%, as well as IMF of negative 3.6%. Now looking into inflation, inflation for the month of August eased to 2.4% from the 2.7% print in July. However, the 2.4% is faster than the 1.7% recorded in the same month last year. So we saw a steady increase in food prices, but on a softer side, while transport costs continue to push prices up as more public vehicles resume operations. So from the BSP, they're looking at a 2.3% inflation forecast for 2020, while currently we're averaging around 2.5%. Then for 2021, the central bank will see faster increase in prices to 2.6%, while for 2022, the country could hit a 3% inflation, well within the BSP range of 2 to 4%. So we go now to the interest rate corridor. So currently, interest rates are still at a record low of 2.25%. That's for the reverse repurchase or the gold line, as you can see in the chart, while lending and deposit facility is at 2.75 and 1.75% respectively. Also, reverse repurchase is at 12%, while BSP Governor Jokno promises to hit single-digit reserve requirement before he steps down. Also, the Monetary Board officials kept interest rates steady during their last meeting in August 20, while they will meet again this week in October 1. Um, Analysts are looking at rates to stay steady, while there could be a possibility of a 25 bips rate cut before the year ends. But BSP Governor Jokna assured that interest rates will remain low through 2022 as he allows the financial markets to absorb these low interest rates. And with that, the banks have started to reduce interest rates on peso and dollar savings account. Also, BSP placed an interest rate cap on credit card transactions, which aim to ease the financial burden of consumers in micro, small, and medium enterprises due to the difficult economic environment caused by COVID-19 pandemic. There's also a 60-day grace period under the Bayanihan 2, so this is on top of the 165 billion stimulus package. So banks will have to comply to this moratorium, and later we will discuss what could be the possible effects of this on the earnings of banks moving forward. So for the next chart is the USD and Philippine peso, wherein peso is at its strongest level since November 2016, hovering around 48.37 against the dollar. So the strong peso is driven by performing US dollar, as we can see that there's some heightened tension over the US as they near the US elections, particularly with their increased tension with China. And then stronger peso is also driven by the narrowing trade deficit as exports continue to increase as compared to imports. So this is good for the country as we um, track our path towards recovery, even if we're still reeling from the effects of COVID 19. So, as mentioned again, recovery in OF remittances continues to spur stronger peso, as well as record level in foreign reserves. So, who benefits from strong peso? These are the importers of oil and raw materials, as well as the national government who continues to pay foreign denominated debt, and as well as corporates who have foreign debt in their balance sheet. But on the flip side, exports will become more expensive and less attractive to our trading partners because of the strong peso. Also, the value of OF remittances will diminish because of this strong peso, and the BPO sector will be less competitive as partnering countries will favor cheaper labor, such as the services provided by competitors like India. So these two charts are encouraging right now because, as you can see to your left, OF remittances are slowly recovering. The 2.78 billion US dollars OF remittances is already at pre-COVID level. So what's the story behind this? Are the Filipinos abroad faring better even if they're still reeling from COVID 19? Well, not actually, but it's just the Filipino culture that when our relatives are experiencing difficulties, the these these expats or OFs tend to give more money or send more money home. So for example, let's say a nurse from UK normally sends around 30,000 pesos to her relatives here in the Philippines, and because of COVID 19, she knows that it is very challenging here in the country given the response by the government against the coronavirus. So what she would do right now as compared to his normal duty is she might send, let's say, 50,000 back home as compared to the monthly remittance of 30,000. So that could be a possible scenario why overseas remittance OF remittances hit 2.78 billion in July. Also, for the next chart is the gross international reserves, where it hit a record of $98.6 billion this July. So it is equivalent to 9 months worth of imports and services. And because of this high reserves level, the central bank decided to go into active gold trading because gold prices have gone up as a safe haven asset during these challenging times. So for the next chart, we should revisit Wall Street. If you can see, this is quite an interesting chart as it stretches 16 years back to 2004. But the highlight here is the blue bar you can see is the performance of US markets during an election year. So the names in bold are of course the winners of the US presidential election. So the trend mainly is that during an election year, US markets tend to gain except for some extraordinary years such as the 2008 financial crisis wherein Barack Obama won against John McCain. Likewise, for this year, 2020 elections, it is also a one-off year as coronavirus happened, and currently Dow Jones is down 4% year to date. And the latest polls showed that Biden is leading against a Trump re-election. But as we near the November elections, we might still see changes that could affect US markets. And of course, US is dealing with their own challenges, such as the approval of second fiscal stimulus plan ranging around 1.5 trillion to 2.2 trillion US dollars. They're also experiencing heightened US China tensions, as I mentioned earlier, as US continues to blacklist China companies, which could further erode trade relations between the two countries when they signed the Phase 1 of trade deal last year. Also, Trump is under the microscope because of his possible appointment of a U.S. Supreme Court justice following the death of a senior Supreme Court justice, Ruth Bader Ginsburg. So, any appointee by President Trump could face some backlash from the Democrats. So, we move now to local markets as PSCI ended at 5838 this last Friday or September 25. So if you can see on the chart, we briefly touched 6,000 level just a few times in September. So 6,000 is a tough nut to crack for the index because of lack of fresh leads, leading to investors to stay on the sidelines. So they could be waiting on factors such as the signing of the 2021 4.1 trillion national budget, which I believe already hurdled the lower house or the Congress and could possibly face um, some debates by the Senate when they try um, to settle it at the bicameral committee. Also, one thing to look into is the government's response against the COVID-19, which could be putting some investors off. So, how does our local index stack up against peers heading into 4Q? So, as you can see, we're down by around 25% year to date, one of the weakest performers in Asia. As you can see, that the markets who fared better were those countries who faced COVID-19 with better measures, such as South Korea and Taiwan, as well as China, who only recorded close to 90,000 cases to date. But in terms of PE, PSEi is faring in the middle of the pack with a reading of 20.4 times. So if we recall back when um, COVID-19 is just starting to spread in the country mid March to April, or when ECQ was in effect during that time. Valuations has dropped or have dropped to 10 to 12 times PE. So why are we now trading at 20.4 times when we seem to be overvalued? So basically, in the first quarter, um, the significant drop in earnings has yet to be factored in. That's why the PSEi gave a reading of 10 to 12 times. Now that corporates are projected to record steep drop in earnings for full year 2020 by around or at least 20%, that's when the lower EPS kicked in the denominator, resulting to a higher PE ratio of around 20.4 times. But again, we're faring better compared to some markets, even the developed markets such as Dow Jones, which has a PE of close to 24 times. So again, looking at the price to earnings band for 10 years, um, three key results will come out by mid-November or early November. However, you can see on this chart that at 20 times PE, we're becoming a bit overvalued, higher than the average of 17.7 times, as you can see the solid black line here. So this is around 17.7, and valuations have become expensive during this time. One way for the PE to regress to around 17.7 times is that 3Q earnings could there could be positive surprise in 3Q earnings coming from resilient sectors such as telco and consumer staples. So later we'll touch on how would those sectors perform. So touching briefly on sub-indices, financials and property continue to post steep losses year to date. Financials down 38%, then property down by 34%. So of course for property, slow recovery in footfalls across its malls is one of those factors that investors are looking into, as well as the low residential sales heading into fourth quarter because of the slower completion of construction of residential projects as well as commercial projects. Well, for financials, I think the Bayanihan 2 Act is detrimental for the financial sector in some ways, and we'll touch on that later. While services posted the low better or posted decline of negative 5.5% as telco has been resilient during this pandemic. Then share price performance of PSCI stocks. So basically it's the same names that have been outperforming for the last 6 months or for the 6 months of quarantine period, such as Tel, Globe, Pure Gold, and we have a newcomer in the name of Emperador. So are people really drinking a lot of Emperador during this pandemic? I don't think so, but of course, its entry in the PSCI, replacing Semirara or SCC, was a positive development for the share price as foreign investors likely snag up on the shares. So looking at the daily value turnover, the 5.3 billion per day was the lowest for the last 12 months. So if you can see in August, 8.2 per day, partly because of the listing of the first REIT company, Ayala REITs or A-REIT. While for September, we have there's no IPO for the month, so that's why, or that's one reason why value turnover reverted to the 5 billion levels. Then for foreign outflows, foreign funds continue to dump Philippine equities to the tune of around 11 billion pesos as of for the month of September. Why? I think it's because of the grim outlook for the country, the negative 5.5% forecast from the government, as well as the negative 8% forecast from credit raters has dampened foreign confidence for Philippines. But of course, as the situation improves, we are quite sure that foreign funds will place their funds again in the emerging markets like the Philippines. So we go now to the strategies or sector review for local equities. For telco, we remain positive as big players continues to expand and improve its network capacity. So we already have seen developments in 5G in some areas, such as Makati and Taguig. However, for some far-flung areas, 4G has yet to materialize. So that's where the key players, Globe and Tel, need to focus into rolling out their telco infra. So these two companies have been consistently paying out dividends, even if capex has been elevated, and even if there are cash constraints during this pandemic. So now that offices or some have returned to their offices, we might see some increased contribution from corporate data. But of course, mobile data will remain the main driver in revenues for third quarter and the fourth quarter as more people continue to stay indoors. Also for telco, they continue to um, present healthy balance sheet with no major debt expiring over the next 2 years. So downside risks are the delayed rollout in telco infra because of some areas are still in tighter lockdown measures. So there could be limitations on the rollout and construction of this infra, as well as the ongoing noise from the positive developments over the perceived fourth telco player and of course the rollout of the third telco player Dito community. So you can see on the chart that there has been a dip on mobile subscribers for Globe, but for Tel, it has steadied at around 73 million, only suffering a dip during the second quarter of this year. So next is consumer retail, where we changed our view from positive to neutral. One thing to look into is, or one the positive points for consumer retail is the ramp up in operations towards 4Q. As we know that 4Q has been relatively strong for FMCG sector or fast moving consumer goods, while for restaurant operators, they are now innovating ghost kitchens to reshape restaurant economy. So, what are these ghost kitchens? Basically, it contains the kitchen equipment and facilities needed for preparation of restaurant meals, but it has no dining area for walk-in customers. So an example for this is if you were to see a pizza kiosk or stall wherein they only serve pizza and you go for carry out of their pizza. So those pizza most likely came from ghost kitchens that are delivered into that kiosk. So that has been shaping up in our country. Big players such as Jollibee has established ghost kitchens as well as Shakey's, While for Maxes, they continue to have their commissary, which is also one way to future proof their business post COVID 19. And for restaurant operators, they are further integrating delivery and carry out in the sales mix. This is done by partnering with food aggregators such as GrabFood and Food Panda. While these services could eat up a little bit of their margins, it's the sales that it's the spur in sales that creates synergies for food aggregators and restaurant operators alike. So, for the downside risks or the negatives, higher incidence of unemployment will result to adverse demand shifts. So, for those unemployed people, I think their their focus or their preference in products would be food on the table, mainly canned goods, rice, rather than spending their savings eating outside or um, eating outside restaurants. Then again, delivery and carry out will only partially offset dine in revenues. So for most restaurant operators, dine in sales make up around 60 to 70% of total revenues, while this has been outstripped by um, carry out and carry out and delivery. We These two will continue or will not offset the 60% dine-in sales. So that's how it works. So now looking at this chart from the BSP or the consumer, this is the Consumer Confidence Index or CI. So based from the latest survey of the central bank, consumers are still pessimistic on the outlook for the next quarter and for the um, for the current quarter and the next quarter, while optimism will only spike over the next 12 months as people would believe that there could possibly be a vaccine against COVID 19 or people have managed to live with the virus, dealing it with optimism. So for the next sectors, we have power and oil. So we turned positive for power and oil as industrial and commercial segments for power companies are back in the mix. So during the tighter lockdown, revenue from power companies were mainly driven by the residential segment, which of course could not offset the contribution from these industrial and commercial segments. Also, power generating companies will continue to add capacity by 2021, and global coal prices seem to have bottomed out. So for the negatives, oil inventory losses for companies likely in third quarter, although at a lower scale compared to second quarter. Then rate rebasing will impact power distribution companies like Meralco, but this will have no effect for power generating companies such as Aboitiz Power and Semirara, and as well as FGen. We go now to infra and cement, where our view turned positive because, of course, easing inflation and strong peso will benefit the import of construction materials. Likewise, the resumption of construction activities in areas under GCQ, although construction activity is still limited by IATF to around 50%, but this is again positive for the sector. And the government is really looking into fast tracking key build projects, as the Department of Finance reiterated that these key infra projects have the multiplier effect and which could spur higher growth rate should it materialize at a faster pace. So one downside for the sector is that operations have yet to return to pre-COVID levels. So we go now to banks, wherein we change our view to negative. So even if we have a negative view, there's still some positive things to look into for banks, as asset quality would deteriorate at a lower pace due to the implementation of Bayanihan 2. So BSP forecasted that asset quality could deteriorate, or NPLs, non-performing loans, could reach 4% by year end, as most of borrowers from the MSMEs will face challenges servicing their loans. However, because of the Bayanihan 1 and this recently signed Bayanihan 2 Act, banks could yet to come out with the accurate figure on how NPLs would spike. As of course, these Bayanihan Acts mask the um, real impact on non-performing loans. Then, given this low interest rate environment, funding costs will remain low for banks, which could help increase their non or net, which will help increase their net interest income. Also, given the low interest rates, there are still opportunities for trading gains as banks try to unload some of their fixed income portfolio to shield their or to offset the higher provisions recorded during the first half and as well as for the succeeding quarters. So we go now to negative for the banking sector. So because of this 60-day grace period or moratorium, there will be lower collections from banks, as there will be no interest on interest charges as well as fees from late payments. So this could be a drag on non-interest income for banks in terms of lower fee collection as well as in net interest income. So this will negatively impact the revenues of banks altogether. Also, the cap on credit card rates will hurt margins, fees, and net interest income. So previously, banks charged 3.5% to 3.75% interest rate for credit card per month. So with interest rates capped at 2% per month, so they're losing 1.5% per month in terms of fees from late credit card payments as well as interest income from, of course, these from credit cards. So this could be negative on banks that has been relying on or have heavy exposure on credit card loans, such as Metrobank and um, consumer centric or consumer focused banks such as East West Bank. And of course, with weaker collections, banks could face some um, tightness in their cash position, also translating to weaker credit activity, as banks might be forced to stop lending as they experience some cash crunch. So we go now to property, where we have a neutral view. Positive points for properties that foot traffic for malls have shown signs of improvement after um, we were promoted from MECQ to GCQ. So remember back in August when we reverted to MECQ, malls have suffered decline in foot traffic once again because of that. Then for offices, occupancy will recover as some employees resume work. The negative points for properties that limitation of construction activities will be a drag on their revenue recognition. particularly property companies recognize revenues through percentage of completion method. So because of this delay in construction progress, these companies could not start to recognize revenues for their projects, be it residential or commercial. Then mall tenants are exploring options outside malls for their expansion plans. So we've seen that, or we might face a future where stores will be mostly, or some stores will just set up online rather than setting up in malls, as foot traffic have significantly dropped because of these quarantine measures. And this could be a bleak future for mall operators such as SM, Ayala Land, Robinsons, among others. Then of course, there's still the pogos are still an overhang, as the exodus of pogos could negatively impact office and residential segment. So there are news that around 10% of pogos are moving out and impacting around 10% of the office occupancy. So this is still developing, it would be something worth looking into. Then I think this is the last sector, gaming. So we turned positive for gaming as there's a PAGCOR directive for casinos to resume 30% of operations. While only at 30%, this is far better than during ECQ, when casinos are barely operating, where only their hotels and restaurants contribute to revenues. While we see this as positive, cost saving measures such as furlough or laying off of employees have somewhat eased the balance sheet of these casino operators, as they plan to shift to 30% operations. While negative points are the slow recovery in VIPs, so we don't know yet if VIPs have come back to gamble in the Philippines, while expansion plans are put on hold and could be delayed further because of the limitation in construction activities. So to make things easier, we made a table for strategy for dividends as well as strategy for price appreciation. So on the left side, you can see that the companies under our coverage that gives out better dividends, such as Semirara, Tel, Globe, Aboitiz Power, Meralco, and Philinvestland. However, you should be wary about um, the companies that could be struggling giving out dividends for this year. So, particularly in this list, we excluded Shell Philippines after they announced that they will not be giving out dividends this year. But maybe if market improves next year, they could resume giving out dividends, as Shell Philippines has been one of those consistently paying out generous dividends to around yielding around 5 to 8%. Then to your right, we laid out companies that have high upside of at least 15%. Again, these are the companies under our coverage. But of course, there are some caveats, as our valuation is, of course, forward looking. So, given the target price, some companies tend to give out some or very high upside, as prices may have been subdued for the past few trading sessions. But if you were to check our reports on our website or on your trading platform, we continue to um, enumerate on the valuation and the catalysts for these companies on why we have arrived at these target prices. So if you can see, Semirara or SCC is consistent by giving out a good dividend yield of close to 13%, and with a 16.44 target price, it has a high upside of 65%. So key takeaways for this webinar: economic numbers showed signs of gradual recovery, but of course, the road remains challenging. We've seen recovery in OF remittances as well as the trade position of the country, so we're recording narrower trade deficit as we enter 4Q. And of course, 4Q will be pivotal for a possible 2021 rebound. Some sectors have showed rebound as early as 3Q, but of course, most sectors will continue to bleed for the remainder of the year. Then, easing lockdown measures should translate to better results come third quarter, so results will be out by November, but earnings growth still point to negative. So for our forecast, we're pointing to around negative 20% earnings growth for the companies that we cover, and this point to a index level of 5,800 to 6,600. So that's our base case forecast for PSEi, while a bear case would hover around 5,300 and a bull case could hit 6,800 by year end. But with only a little more than 3 months left, that could be challenging um if operations remain limited because of these quarantine measures and as COVID-19 infections continues to rise. So we advise investors that risk of sentiment could prevail in the short run given the absence of fresh catalyst in the market. While there could be attractive upside for companies that are positioned for a strong rebound post pandemic. So, for those companies who have adapted or innovated a new business model that could help them propel for better 2021. So, of course, we advise you to slowly accumulate those stocks. And last but not the least, we always advise you to manage your risk. So that's it for another USI webinar. Stay tuned for our upcoming webinars, and I hope you learned something today. So thank you guys and stay safe.